Intensive training on the cycle, operational dynamics, and handling challenges of demand guarantee. This training is of very important, great importance to us as a nation because of the level of development we are having in Nigeria right now. If we are going to be able to do business efficiently, if we are going to do business effectively, if we are going to be able to do business in such a way that they can build credibility, we need this particular instrument. Very, very important. Guarantee is a major instrument used around the world to ensure that nations are able to finance SMEs, to allow investors to invest in a particular economy or to invest in a particular sector of the economy. If an investor is coming to Nigeria, for example, and is going into farming, African Development Bank have given Nigeria about $500 million guarantee. And what that means is that if they are going into that sector and they need to borrow funds to be able to build in that sector, there is a guarantee for what they are borrowing, such that the company that now is funding them either from abroad or locally is willing to fund them because a guarantee has been provided by the African Development Bank. So what that means is that African Development Bank is guaranteeing that look, if you fund this project and anything goes wrong, you are not unable to pay back, we, through this guarantee, are going to pay back. So it's very important to our economy, it's very important to different phases of our economy, it's very important to business generally. In fact, one of the inventions, in my own opinion, that is really very, a very creative invention that have been invented in the last century, as far as I'm concerned, is this guarantee. Although when it started, Americans did not want it in the US because of the challenge. But the kind of guarantee that the Americans were using was not the demand guarantee we should be talking about today. Americans were using what we call the accessory suretyship. It's a form of guarantee, but not a demand guarantee, and I'll try to distinguish them in the course of this training. This Impex Trade Academy is the foremost international trade training company in Nigeria. Our vision is to contribute significantly to the growth of trade knowledge, trade funding, and trade volume to foster national development. And our mission is to promote trade education in Nigeria through trade facilitation, development of effective trade finance strategy, which guarantee is a major instrument for most finance that you have to do. A form of guarantee is a major instrument used for financing, and dissemination and sharing of trade information, which we often do online. That dissemination and sharing of trade information, you can see it on www.tradeinfong.com. www.tradeinfong.com. Our faculty is made up of about 7 trade finance experts with local and international trade exposure in the field of international trade finance and aggregate experience of about 50 years. What makes us very unique as an organization is the fact that we have a theoretical knowledge in numerous trade certifications, we have banking background, structured trade finance in particular, and document processing, and more importantly, we are not going to be teaching theories, we teach practical, because these are things we do on a daily basis because we are actively involved in international trade itself. We trained a number of organizations in the past, and we are the only company in Nigeria that IFS School of Finance, now IFS University College, has approved 4 of our training courses. And incidentally, this guarantee is one of those courses that has been approved by IFS University College to be used as a training that people that want to do certified documentary credit exam in Nigeria, people that have passed the exam in Nigeria, can use to do their re-certification, which is called the Personal Development Unit. So for everyone that attend that training, they have access to 8 PDUs, 8 units of what they need to re-certify as a CDCS specialist out of the 24 that they have. So by the time they do 3 of our training, they are already covered all the requirements for them to get their re-certification done. In this training today, we expect that every participant of the training should be able to understand the different types, usage, and functions of demand guarantee, what differentiates a demand guarantee from other instruments. I'm talking more about that. The fundamental principles of demand guarantee. Just like we have a letter of credit. Letter of credit, we have fundamental principle of letter of credit. We have fundamental principle of demand guarantee. What exactly is demand guarantee based on? The features of a typical demand guarantee. The features of a typical demand guarantee. ICC rule that guides demand guarantee. And this rule is called URDG 758. Uniform Rule for Demand Guarantee. URDG 758. So we're looking at the benefit of this URDG to the parties, the components of the life cycle of the guarantee. Every finance instrument, letter of credit, standby letter of credit, guarantees, all of them have a life cycle. From the time of drafting to time of issuance to time of amendment to time of presentation of documents to time of payment and lastly termination of such an instrument. Then the components, the transaction dynamics of trade level guarantee, we expect we should have a better understanding of that, and also how to handle challenges as far as guarantees are concerned. So I want to ask a question: what is guarantee? What is guarantee? Preferably, what is demand guarantee? Remember, let's have a mindset as we look at after this lecture, a mindset. What exactly does guarantee seek to solve? I want you to supply me a product. For example, supply me the training chairs in this office. I've given you 30 days to supply. Now, I would have given that job to someone else. So I do not want any form of disappointment. You are my supplier, so you might be my exporter shipping this product to me from China. I am the importer, and I'm saying, give me a performance guarantee. Are we together? Are we together? Give me a form of assurance that you will supply. Meaning, if you fail to supply, you are going to pay me for your default. We can switch roles. We can switch roles. You can say, look, I don't trust that you will pay me when I supply this product. Because I'm not sure of your payment, you are now telling me, instead of me telling you now, so now it depends on who is negotiating, who is having the higher negotiating power. In this case now, who is having the higher negotiating power. On the other hand, I'm having the higher negotiating power because I'm buying, and I could have bought from someone else, and I'm saying you have to give me a performance bonus. In this case now, you as a supplier, you are having the higher negotiation power, and you are saying, look, I'm not willing to sell my product to you in Nigeria, I'll sell it to someone else. So many people want my product. So if you want me to give me, supply you, give me a payment guarantee. That is similar to letter of credit. Very similar to letter of credit. Very similar to standard letter of credit. But it's not letter of credit because I will only go and call on that guarantee to ask for payment if you default. Am I communicating? Because now you are asking me to do what? To pay you, to give me a guarantee, am I right? I'm giving you a payment guarantee. So when you supply me and I fail to pay, then you go and call the guarantee. Meaning, if I pay you, what happens to the guarantee? What happens to the guarantee? It's of no use. It ends. It's of no use again. Why? Because I've what? Paid you. So we can switch roles. As an exporter, I can ask for payment guarantee. As an importer, I can ask for what? What? Performance guarantee. Performance guarantee. Now, look, imagine this scenario. Imagine a situation where you are the exporter in China and you say, look, guy, I don't trust you. For me to go and waste my money to produce this thing, before I even start, I need to give you a commitment. Give me some money in advance. And I say, you are in China. A lot of things happen in China. We don't trust you guys there. And you say, we don't also trust you in Nigeria. Okay, no problem. Let's strike a deal. I will give you the 50% advance you are asking for. But before I give you, get your bank to give me an advance payment what? Guarantee. What am I trying to say? I'm trying to say that give me an advance payment guarantee, then I give you the money. So that at the end of the day, if you fail to ship my goods, what happens? I go and call on my guarantee. And if you ship, the guarantee is null and void. Are we together? So it's good we understand the basic foundation of what a guarantee is. It's extremely important we understand it. When we have understood it, then life is easy for us to understand whatever that we discuss. So all I want to talk about now is, okay, this process that we have described in 2-3 minutes, how do we go from here? That's the whole idea of guarantee. How do we go from here? So what ICC did was to come up with a rule. And you know the beauty of ICC rule, just like letter of credit rule, rule for uniform custom practice letter of credit, a uniform rule for collection, for bill for collection, a standby practice for IS for standard letter of credit. All those rules. There is one thing I like saying about the rule. This IBC rule makes every one of us to speak the same language. Are we together? It allows us to do what? Speak the same language. Meaning, if I do anything abroad, whatever I do abroad, the same thing you will do in Nigeria. If for any reason I do anything unknowingly, but I agree to the rule, either I know it or not, the rule still what? Applies. So I had better know the rule before I agree that it guides my transaction. And a lot of guarantees are issued without a rule. And do you know the problem of that? That means the drafting process will be too cumbersome. Because now there are so many things to be covered, and you're going to see it shortly. Very interesting things to be covered. But with URDG, some things I should have said that I don't need to state. Let me give you an instance. URDG says when a guarantee do not specify an expiry date, that guarantee expires 3 years after issue. Am I communicating? A typical example is a shipping line guarantee. If you want to go and pick up goods from shipping line and you have a bill of lading, they want you to guarantee them. And most of the time, the guarantee you give them is usually for a long time. A long time. If you subject that guarantee to URDG says, if no indication, no expiry date, no expiry event, you know what it means? That guarantee that has no expiry event will expire 3 years after issue. Am I making sense? That solves a problem. There is a default application. Another example, if the guarantee did not state who is to bear the charges, either of amendment or of issuance, you know what the rule says? The rule says whoever gives the instruction to the bank to do something, bear the charges. Am I communicating? Do we understand? So some things are assumed are given. Why? Because there's a rule. So subjecting your transaction to the rule is going to be of benefit to you. UN commercial arm have already adopted URDG. A lot of nations and countries are using it. If you are in Nigeria, you have to issue a guarantee abroad. This is what they will ask you. Locally, it's supposed to be used, but from the few guarantees we'll be reviewing in this class as case studies, the number of people who issue guarantee in Nigeria do not subject to URDG, which for me is not acceptable. It's not acceptable. Why? Because it leaves it exposed, and I will show you as we get along. So let's go into the world of demand guarantee. What is a demand guarantee? A demand guarantee, also called independent, autonomous, or forced demand guarantee, is an irrevocable undertaking issued by the guarantor upon the instruction of the applicant to pay the beneficiary any sum that may be demanded by the beneficiary up to a maximum amount determined in the guarantee upon presentation of a complying demand complying with the terms of the guarantee. Hello? Let's look at the key point. Number one, it can be called independent guarantee, it can be called autonomous guarantee, it can be called forced demand guarantee. It is, number one, irrevocable. And what that simply means is that none of the parties involved, and who are the parties here? Who are the parties here? From the screen, who are the parties? Anybody? Number one is what? Guarantor. Number two is what? Applicant. Number three is what? Beneficiary. Now, these are the three people involved. These are the three people involved. These are the three people involved. But remember, the same principle that apply under letter of credit applies there. In the letter of credit, the applicant is not a party. Am I communicating? Who are the parties in the letter of credit? The issuing bank and who? The beneficiary. The same principle apply here. Who, now, although three people are involved, but who are the parties that have obligation under the guarantee? You know, for every guarantee, there is an underlying contract. Come back to the case of our transaction. You have to supply me chair from China, right? So we have an agreement to supply what? Chair. That's an agreement between me and you. That agreement is independent of the guarantee your bank gave me as performance guarantee. So me and your bank are the parties to the guarantee. You are not. You have applied to your bank. Your bank is acting on your behalf. Am I communicating? So we have irrevocable undertaking. It's an undertaking, and it's irrevocable in the sense that either me, the bank, or the beneficiary. So either your bank in China and me, the beneficiary, importer in Nigeria, none of us can pull out or do any amendment without every one of us agreeing to it. So when you say it is irrevocable, what it means is that nobody can wake up tomorrow and say, I'm no more interested. And the other party must agree. The other party must agree. It is issued by a guarantor. Most of the time, the guarantors are banks. Most of the time. But it can be an organization. It can be an insurance company. It can be any financial institution. But most of the time, people prefer banks. Look at why people prefer banks. He said what? Upon instruction of the applicant to pay what? Any sum. It involves payment of money. So it's not a guarantee where I guarantee you, then the bank will go and supply the goods because you supply. No, the bank will pay me for your default. Am I complicating? Are we together? The bank does what? Pays me for your default. So it is irrevocable. It involves a guarantor. The guarantor issues after receiving an instruction. So there must be an instruction. But you know what? The guarantor also can be the applicant. Hello? The guarantor can be what? Imagine a situation where I'm a bank in Nigeria and I'm importing my chair from China. And the company abroad said I should give him a payment guarantee. And I'm a bank. And I'm importing that to one of my branches. Who is the applicant in that guarantee? I. Who is the guarantor? I. So you can have a situation in which one person is playing two roles. So there must be an instruction from the applicant to the guarantor. Now, the person that is supposed to perform under the contract is the applicant. Are we together? But the person that informs the guarantor to issue is called the instructing parties. Am I communicating? Look at it. I'm a bank in Nigeria, right? I have a branch, am I right? I have a branch. Let's do it this way. I'm a bank in Nigeria. I have a branch in Cotonou. I need to import from Cotonou to what? From China to Cotonou, right? Are we together? The agreement is between my branch in Cotonou and the supplier in China. Are we together? So they have an agreement. The applicant now is my branch because it's the one that's supposed to perform. But the applicant now is telling me, the bank, that I should issue a guarantee on his behalf. I'm the head of it, right? Let me remove it from bank so that it will be clearer. Let's assume a company like, let's say, Nestle Food. Nestle Food. Nestle Food is building a factory in Kaduna. He's doing a factory in Kaduna. And his branch in Kaduna is the one building it. His subsidiary is the one building it. That subsidiary of Nestle Food is the one that have an agreement with the supplier in China. Are we together? So they have a relationship, am I right? Underlying relationship. So the applicant is who? The guy in Kaduna, the branch in Kaduna. The branch in Kaduna now, on his behalf, I'm instructing the bank, maybe let's say Zenith Bank in Nigeria, to issue what? Guarantee to who? The China. Now, in this case now, who is the applicant? My branch in Kaduna. That's the person obligated under the contract. Who is the instructing party? I'm the one. Instructing, I'm the head of it. Instructing who? The bank. Am I communicating? So, applicants sometimes can be the instructing party, and sometimes they can be what? Different. Are we together? So, the guarantor instructs the applicant to pay the beneficiary any sum that may be demanded by the beneficiary up to a maximum amount. So a guarantee always have a ceiling, a maximum amount. It involves the payment of money that may be demanded by the beneficiary up to a maximum amount determined by the guarantee. So the guarantee already determines the amount. Upon presentation of a demand. Under L2, we say presentation of a document. Presentation of a demand. The demand must comply with the terms of the guarantee. The demand must comply with the terms of the guarantee. Any question? Any question? Now, as far as the bank or guarantor issuing the guarantee is concerned, such instrument is a contingent liability. Contingent liability means a liability that could likely happen. A bank has given a guarantee. So what if the supplier is not supply? I ask for a performance bond. Your bank in China has given it to me. What if you don't perform? What happens? What happens? The bank pay, right? So the likelihood of you not performing is a contingent liability of the bank that issued guarantee on your behalf. So it's contingent liability, which may require the bank to pay out on behalf of his client at some point, at some future date. The bank will therefore treat the situation as a credit facility requiring a covering limit or a deposit of cash covered by the client. No bank. Banks are not in the business of taking risk. So no bank will issue a guarantee without a cover. The bank will treat it as if you want to collect a loan. And the implication of that is that they get a collateral to cover. So that if you fail to pay a loan, the bank will go and use the collateral to recover their money, right? Good. In like manner, this guarantee, if you fail to perform and eventually the bank has to pay on that guarantee, the bank will have to recover the money from you as the one that came to ask him to issue a guarantee. So the bank will what? Seek for a cover before he issues the guarantee. Do we understand? Alright. Let's look at a typical guarantee. Here is the applicant in China. Here is the beneficiary in Nigeria. This is the underlying transaction. So they have an agreement, supply me shares. Here is the application for a performance guarantee. A performance guarantee showing that I will perform. In case I don't perform, we will call on the guarantee and recover our money. And recover the money for the loss you have made us incur, for the delay you have caused us, you are paying us, compensating us for it. So what that means is that if it's a performance guarantee, assuming this value, the value of this transaction is $100,000, the application here for this guarantee might be just about 5%. Am I communicating? 5% because you are compensating me for the false, so it can be 5%. He is the guarantor. The guarantor issues the guarantee to the what? Beneficiary. Am I making sense? Number one, there's an underlying contract between applicant and beneficiary. Number two, the applicant applied for the guarantee. Number three, the guarantor issued the guarantee to the beneficiary. And the case is closed. We are going to shortly discuss indirect guarantee. How does indirect guarantee work? I want you to give me a performance guarantee, right? Your bank. Because your bank is far away, and because anything will happen that could prevent you from getting that money because it's in a different country. I'm in Nigeria.